Imagine two people standing in the same bank on the same Friday afternoon. They're both 30 years old. They both live in Columbus, Ohio. They both earn $75,000 a year. They both have $25,000 sitting in their savings account. They've both spent weeks reading articles, watching videos, and asking friends one simple question. What's the smartest financial move they can make right now? Emma decides to follow the advice she sees everywhere online. She uses every dollar she has to make what she believes is the responsible financial decision. She feels safe, she feels disciplined, she sleeps well that night. Ryan makes the exact opposite decision. Friends tell him he's taking a risk. Family members quietly shake their heads. Even he wonders if he's making a mistake. 5 years later, one of them will quietly pull ahead. 10 years later, the gap becomes impossible to ignore. 20 years later, the difference isn't just money. It's freedom. It's options. It's the ability to say yes to opportunities that the other person simply can't afford. Here's the strange part. Both of them think they made the smarter choice. And they're both wrong. Because the biggest financial mistake isn't choosing one path over another. It's believing that every generation's favorite financial rule applies forever. Every generation has one sentence it repeats with absolute confidence. Pay off debt as fast as possible. Real estate never goes down. Cash is king. The stock market is too risky. Renting is throwing money away. Different decades, different headlines, different economic conditions. The advice changes, but the mistake stays exactly the same. People stop asking one question. Does the math still work today? I'm Professor Wealth, and today we're going to run the numbers instead of repeating the slogans. To keep this fair, Emma and Ryan start with identical conditions. They're both 30 years old. Both earn $75,000 annually before taxes. Both receive the same 3% annual raises. Both already have 6 months of emergency savings outside the money we're tracking today. Both have $25,000 available to invest or use however they choose. Neither receives an inheritance. Neither wins the lottery. Neither starts a business. Same city. Same income. Same starting cash. The only difference is one financial decision. Emma believes the safest move is to eliminate every dollar of her low-interest debt before investing seriously. She has a $25,000 student loan at 4% interest with 8 years remaining. Instead of investing, she pays it off immediately. Ryan looks at the same loan and reaches a different conclusion. He keeps making the required monthly payments of roughly $305. Instead of using his $25,000 to eliminate the loan, he invests the entire amount into a broadly diversified, low-cost stock index fund. Right away, this feels uncomfortable. Emma has no debt. Ryan still owes $25,000. Ask almost anyone at a family dinner which person is winning. Most people point to Emma. No debt feels clean. It feels responsible. There's no monthly obligation hanging over her head. She owns that feeling completely. Ryan, meanwhile, opens his loan statement every month and still sees a balance. Psychologically, it feels like he's behind. That's important because feelings and math are two very different things. Feelings are immediate. Math usually takes years to introduce itself. Now let's freeze everything except the numbers. Emma saves the $305 she no longer sends to the loan. At the end of every month, she invests that amount into the exact same low-cost index fund Ryan owns. Ryan invests $25,000 on day one and continues making his required student loan payments. That's it. No tricks. No secret investments. No lucky stock picks. Just one different decision. On day one, Emma's loan balance is $0. Ryan's investment account is $25,000. On day one, Emma feels richer. Ryan actually owns more appreciating assets. Those are not the same thing. Historically, according to long-term data published by the Federal Reserve and market research from S&P Dow Jones Indices, diversified U.S. stock investments have produced average annual returns close to 10% before inflation, over very long periods. Although returns vary significantly from year to year, Ryan knows those returns aren't guaranteed. Emma knows eliminating 4% interest is guaranteed. Both facts are true. The question is, which one creates more wealth over time? Let's see what actually happens after the first year. Ryan's investment experiences a perfectly ordinary market year and grows 8% instead of the long-term average. His $25,000 become $27,000. During that same year, he pays about $3,660 toward his student loan. Only around $900 of that is interest. The rest reduces principal. His remaining balance falls to just under $22,200. If you subtract that loan balance from his investment account, his net investment position is roughly $4,800 ahead. Emma starts from zero because every dollar went toward eliminating debt. Instead, she invests the $305 she no longer sends to the lender each month. Assuming the same 8% annual return, she finishes the year with approximately $3,800 invested. No loan. $3,800 in investments. On paper, Ryan appears to have a larger account. Sounds impressive, until you subtract the debt. On paper, Emma appears completely debt-free. Sounds even better, until you realize her investment account is smaller. Already the comparison is becoming less obvious than social media usually makes it sound. Now let's move forward another 2 years. By the end of year 3, Ryan's original investment has experienced perfectly normal market fluctuations. 1 year is strong, 1 year is flat, another is slightly negative before recovering. Overall, the account has grown to roughly $31,500. His student loan balance has dropped below $16,000. His investment minus remaining debt leaves him with approximately $15,500 in net financial assets tied to this decision. Emma has faithfully invested every single monthly payment she no longer owes. She's never missed a contribution. Her discipline deserves credit. By the end of year 3, her investment account reaches approximately $12,000. She's still debt-free. She's also sleeping peacefully every night. Neither outcome is wrong. But notice what's happening beneath the surface. Ryan's money had something Emma's didn't. Time. Every dollar invested on day 1 had 3 full years to compound. Emma's dollars entered gradually, 1 paycheck at a time. That's called opportunity cost. It's one of the most expensive financial concepts you almost never hear people brag about, because you can't see it on a monthly statement. You only notice it years later. And this is exactly where generations begin repeating the same mistake. They compare feelings today instead of numbers tomorrow. Because if all you measure is the satisfaction of becoming debt-free, Emma wins immediately. If all you measure is investment growth without considering risk, Ryan looks unbeatable. But we're not done running the numbers. Not even close. Because by year 5, something happens that almost nobody sees coming. By the time year 5 arrives, something interesting has happened. Not dramatic. Not flashy. Nobody posts about it on social media. But this is where the story quietly changes. Ryan's original $25,000 investment has now been in the market for 5 full years. It didn't climb in a straight line. 1 year, it gained more than 12%. Another year, it lost nearly 10% before recovering. That's exactly what long-term investing looks like. Messy in the short term. Predictable only over long periods. After those 5 years, his account has grown to roughly $38,000. Meanwhile, he's continued making his required loan payments every month. His remaining student loan balance has fallen to just under $9,000. Subtract the liability from the investment, and Ryan's net position connected to this decision is about $29,000. Emma has continued investing the $305 every month without missing a single contribution. Her consistency matters. In fact, it's doing most of the heavy lifting now. At the end of year 5, her investment account has grown to approximately $22,000. She has no debt. Ryan still does. Ask 10 people which situation feels safer. Most would still choose Emma, but here's where feelings and math begin moving in opposite directions. Ryan's investment has earned more than $13,000 since day 1. His total interest paid on the loan over those first 5 years is roughly $4,200. On paper, earning $13,000 while paying $4,200 sounds fantastic. Sounds great until you subtract everything else. Investment gains aren't guaranteed. Some years they're negative, and that's exactly why many people never stay invested long enough to collect the long-term reward. The biggest enemy isn't volatility, it's panic. According to Dalbar's long-running quantitative analysis of investor behavior, the average Dalbar's equity investor has historically earned significantly less than the market itself because many buy after prices rise and sell after prices fall. The market doesn't beat most people. Their own behavior does. Emma never had that temptation. She wasn't watching a $25,000 investment swing thousands of dollars in either direction. Her path was emotionally easier. Ryan's wasn't. That's an advantage most spreadsheets completely ignore. Now let's fast forward another 5 years. Year 10. Ryan finally makes his last student loan payment. The loan is officially gone. For the first time since this story began, Both Emma and Ryan are debt-free. Now the comparison becomes much simpler. Ryan's original investment has continued compounding, assuming a long-term average annual return, close to 9% over the decade. Not every year, but on average, his account has grown to approximately $59,000. Since the loan is gone, that's his full net investment balance. Emma has continued investing her former loan payment every single month. 10 years of disciplined contributions have built her portfolio to approximately $56,000. Notice something surprising. The gap isn't enormous. It's only about $3,000. If you stop the video here, you might think this entire debate was overblown. But this is exactly where almost every financial conversation ends too early. Because compounding isn't linear. It's exponential. The biggest gains usually arrive in the second half of the journey, not the first. Think about planting two trees. One is planted today. The other is planted 5 years later. During the first few years, they look almost identical. 20 years later, one casts shade over the entire yard while the other is still catching up. Money behaves the same way. Now let's talk about what almost nobody talks about. Every generation has a favorite financial number. It's usually the one that makes them feel smartest. Debt-free, home equity, pay portfolio balance, credit score, annual return. Pick your favorite. The problem is that none of those numbers tells the whole story. Let's start with taxes. Investment returns aren't always yours to keep. If Ryan sells investments held for more than a year, long-term capital gains tax may apply depending on his taxable income. According to the IRS, federal long-term capital gains tax rates are generally 0%, 15%, or 20%, with additional rules that can apply for higher earners. Emma faces the exact same issue because she's investing in the same taxable account. Taxes don't care who won the argument. They simply reduce returns. Next comes inflation. The Federal Reserve targets approximately 2% inflation over the long run, but actual inflation can be much higher or lower in individual years. A portfolio worth $60,000 10 years from now doesn't buy what $60,000 buys today. Ignoring inflation is one of the easiest ways to overestimate future wealth. Then there are investment fees. Ryan and Emma wisely chose a low-cost index fund, charging only about 0.3% annually. That sounds tiny, but compare it with an actively managed mutual fund charging 1% per year. Over several decades, that fee difference alone can reduce ending wealth by tens of thousands of dollars, because every dollar paid in fees is a dollar that never compounds again. Next comes opportunity cost. This one never appears on a statement. Nobody sends you a bill, but it's real. Emma's $25,000 eliminated a guaranteed 4% interest expense. Ryan's $25,000 immediately began chasing higher expected returns. The opportunity cost wasn't writing a check. It was choosing which future to give up. Finally, behavior. This is the hidden cost that's impossible to calculate precisely. Imagine Ryan invested just before a market decline of 25%. His account falls from $25,000 to around $18,750. Would he stay invested? Or would he sell? If he sells, the entire mathematical advantage disappears. If he stays invested, history suggests recoveries have eventually rewarded patient investors, but only those who remained invested. That's not an opinion. It's simply how compounding works. Notice something else. None of these hidden costs appears in the advice people casually give. Nobody says pay off your debt, unless expected after-tax investment returns exceed your borrowing cost. Nobody says invest immediately, unless your emotional tolerance causes you to sell during downturns. Real life is never that simple, and that's exactly why repeating financial advice from another generation can become so dangerous. Because the interest rates they faced, the inflation they lived through, the investment returns they experienced may be completely different from yours. The slogan survives. The math changes. That's why every financial decision deserves fresh numbers instead of recycled opinions. But before you conclude Ryan clearly made the smarter decision, there's something equally important we need to do. If I only showed you the downsides of paying off debt first, I'd be doing exactly what every investing influencer criticizes everyone else for. And that would make this comparison incomplete. Because there are several situations where Emma's decision doesn't just make sense, it actually wins. And those situations are far more common than most people realize. Let's give Emma the strongest possible case, because if I only showed you the downsides of paying off debt first, I'd be doing exactly what every one-sided financial influencer does. And that's not how you make good decisions. The first situation is simple. If your debt isn't 4%, but 8, 10, or even 24%, the math changes dramatically. A credit card charging 24% interest is effectively earning a guaranteed 24% against you every year. Finding an investment that reliably beats that after taxes and fees is extraordinarily recharging. In that case, paying off the debt first isn't emotional. It's mathematical. The second situation is job stability. Ryan's strategy depends on continuing to make monthly payments while leaving his investment untouched. If he loses his job during a recession and has to sell investments after a market decline, the timing could permanently reduce his long-term returns. Emma doesn't have that problem. Her required monthly payment disappeared on day one. Lower fixed expenses create flexibility. That's a real financial asset, even though you won't see it listed on a brokerage statement. The third situation is behavior. Suppose Ryan opens his investment account during a bear market and sees his $25,000 temporarily fall to $19,000. If he panics and sells, his strategy collapses. Emma never had that temptation. She exchanged uncertainty for certainty. Sometimes the mathematically perfect strategy isn't the strategy you've run. Actually stick with. The best investment plan is worthless if you abandon it halfway through. And finally, there's peace of mind. No spreadsheet can accurately price a good night's sleep. If eliminating debt helps someone sleep better, reduce stress, and avoid financial mistakes caused by anxiety, that's a benefit. It's just difficult to express in dollars. Now let's return to Ryan. Because his advantage doesn't come from taking bigger risks. It comes from one thing: time. Every year that passes gives his original investment another year to compound. And compounding has a strange habit. It starts slowly. Then it starts looking unfair. Let's fast forward another 10 years. Year 20. Emma has now been investing her former loan payment for 2 full decades. She's remained disciplined through market crashes, recoveries, elections, recessions, and headlines predicting the end of investing every few years. Assuming a long-term average annual return of about 9%, her investment account has grown to approximately $190,000. That's an incredible achievement. Remember, she started with nothing invested after using all $25,000 to eliminate debt. Her consistency built almost everything. Ryan's original $25,000 investment has now enjoyed 20 uninterrupted years of compounding. Again, not in a straight line. Some years delivered gains above 20%, others produced double-digit losses. But over the full period, the average return remained close to historical long-term expectations. His original investment alone has grown to roughly $140,000. But that's not the whole picture. When his student loan was finally paid off after 8 years, Ryan didn't simply spend the extra $305 each month. He invested it. From year 8 through year 20, those monthly investments added approximately $85,000 to his portfolio. His total investment balance reaches roughly $225,000. Emma finishes with about $190,000. Ryan finishes with about $225,000. The gap is approximately $35,000. Not $350,000. Not $1 million. About $35,000. Enough to matter. Not enough to declare one strategy universally correct. Because context always wins. Now here's something even more interesting. Let's change just one variable. Suppose Emma invested an additional $200 every month after becoming debt-free. Nothing dramatic. Just $200. Over the next 20 years, assuming the same long-term return, that extra contribution could add roughly $130,000 to her portfolio. Suddenly, she's no longer behind. She's ahead. One small behavioral change completely changes the ending. That's why chasing the perfect decision often matters less than consistently improving the times one you already made. And that's the lesson almost every generation misses. They spend years arguing about the first decision. Very few pay attention to the hundreds of decisions that come afterward. Before we finish, let's ground this discussion in real data instead of internet opinions. According to the IRS, interest paid on most personal consumer debt, including standard, personal loans, and most student loan situations beyond applicable limits, generally isn't fully deductible for most taxpayers. Tax rules depend on income and individual circumstances, but taxes should always be part of the calculation. According to the FDIC, deposits at insured banks are generally protected up to $250,000 per depositor, per insured bank, for each ownership category. Cash offers safety. It doesn't usually offer the long-term growth potential of diversified equities. According to the Federal Reserve, household debt levels and interest rates change over time. That means advice that worked perfectly in one decade may produce very different results in another. The numbers evolve. Your strategy should evolve with them. So what should you actually do? Start with step 1. Calculate the interest rate on every debt you have. Not your average. Every single one. A 3.9% loan deserves a different conversation than a 22% credit card. Step 2. Estimate the expected after-tax return on your investments instead of using optimistic guesses. If your expected long-term return is 8%, but taxes and investment costs reduce that to 6.5%, compare 6.5% against your borrowing cost, not 8. Step 3. Stress test your plan. Ask yourself one uncomfortable question. If your investments fell 30% next month, would you continue investing? If the answer is no, your strategy may be too aggressive for your personality, even if it looks perfect on paper. The best financial plan isn't the one that wins arguments online. It's the one you'll actually follow for 20 years. Let's go back to Emma and Ryan. They both walked away believing they'd made the smart play. Emma believed eliminating debt first was the only responsible choice. Ryan believed investing immediately was the obvious mathematical choice. Neither one actually ran the complete numbers at the beginning. They focused on the part of the equation everyone talks about, not the part almost nobody calculates. Because the real trap isn't paying off debt first, and it isn't investing first. The real trap is making financial decisions based on hype, headlines, family traditions, or someone else's opinion, instead of running the numbers for your own situation. Every generation inherits financial advice. Very few people stop to ask whether that advice still matches today's interest rates, today's taxes, today's market conditions, and today's opportunities. That's where wealth is quietly won, not by following the loudest voice, by following the math. And if you're wondering what happens when someone combines both strategies, keeping low-interest debt while aggressively investing, then strategically accelerating payoff as conditions change, that's a completely different conversation. So here's the question I want to leave you with. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. Until next time, keep questioning the headlines and keep running the numbers.